Do you want to save money on taxes? Of course you do. Who wouldn't? Welcome to our discussion today, where we'll be shining a spotlight on tax-saving tips that are often overlooked but can make a world of difference to your wallet. Understanding the nuances of taxation can seem like a daunting task. But the truth is, there are numerous tax reductions that many of us qualify for, yet remain under the radar simply because we aren't aware of them. As a result, we end up missing out on significant savings. Our aim today is to demystify these hidden aspects of taxation and provide you with practical, easy-to-implement tips that could help you save a substantial amount of money. So whether you're just starting out or have been paying taxes for years, there's likely to be something new for you to learn today. Stay tuned as we delve into these overlooked yet beneficial tax-saving tips. First things first, understand your tax bracket. Now, what exactly is a tax bracket? You can think of it as a set of ranges, each range corresponding to a specific income level. The higher your income, the higher your tax bracket, and subsequently, the more taxes you pay. But here's what's interesting. It's not a flat rate. It's progressive, meaning you're taxed at different rates for different portions of your income. Let's say you're in the 25% tax bracket. This doesn't mean all your income is taxed at 25%. Only the income over a certain threshold is taxed at this rate. The rest is taxed at lower rates. So the more you understand this, the better you can plan your finances. Knowing your tax bracket can open up opportunities for potential savings. It can help you make informed decisions about investments, deductions, and credits. Understanding your tax bracket is the first step towards efficient tax planning. Did you know there are tax credits that could reduce your tax bills? Yes, that's right. We're talking about tax credits, those often overlooked superheroes of the tax world. They might not wear capes, but they sure can save the day when it comes to your tax bills. Now, you might be asking, what exactly are tax credits? Well, think of them as a direct reduction in your tax bill. Unlike deductions, which reduce the amount of income subject to tax, credits reduce your tax bill on a dollar-for-dollar basis. There's a wide variety of tax credits that you might be eligible for. Let's look at a few examples. Have you been hitting the books recently? If you're a student, you might qualify for education credits. The American Opportunity Tax Credit, for instance, can cover up to $2,500 of qualified education expenses. The Lifetime Learning Credit, on the other hand, can provide up to $2,000 per tax return for post-secondary education expenses. So, if you've been investing in your future through education, make sure to take advantage of these credits. How about making your home more energy efficient? The Residential Energy Efficient Property Credit could be perfect for you. It rewards taxpayers who install alternative energy equipment in their homes. Think solar electric systems, solar hot water heaters, and even wind turbines. Not only do you save on your energy bills, but you also get a tax credit. Talk about a win-win. Lastly, let's not forget about the Child and Dependent Care Credit. If you're paying for the care of a child under 13 or a dependent, so you can work or look for work, you might be eligible for this credit. It can cover up to 35% of your allowable expenses, up to $3,000 for one dependent, or up to $6,000 for 2 or more dependents. Remember, tax credits are a dollar-for-dollar reduction in your tax bill. Don't miss out on them. They might just be the superhero you need to save the day at tax time. Here's another powerful tool to reduce your tax bill. Deductions. Now, what are tax deductions? Think of them as discounts on your taxable income. They work by reducing the amount of your income that's subject to tax. The more deductions you can claim, the less income you'll have to pay tax on, and the lower your tax bill will be. There are two types of deductions: above the line and itemized. Above-the-line deductions are subtracted from your income before you calculate your tax, while itemized deductions are subtracted after. Depending on your situation, one might be more beneficial than the other, so it's worth doing the math. Now let's talk about some commonly overlooked deductions. First up is home office expenses. If you work from home, You may be able to deduct a portion of your housing costs, like rent or mortgage interest, utilities, and even internet service. This can add up to a significant amount, especially if you've been working from home a lot recently. Next is student loan interest. If you're still paying off student loans, you can deduct up to $2,500 of the interest you've paid over the year. This can be a great way to reduce your taxable income, especially for younger taxpayers who are just starting out. Lastly, we have medical expenses. If you've had a lot of medical costs in the past year, you might be able to deduct them. This includes everything from doctor's visits and hospital stays to prescription medications and even health insurance premiums. The catch here is that you can only deduct the portion of your medical expenses that exceeds 7.5% of your adjusted gross income. But if you've had a particularly expensive medical year, this could be a big help. Deductions can significantly decrease your taxable income, so make sure to claim all that apply to you. Scene script. Saving for the future can also save you money now. How? By contributing to retirement accounts. Let's delve into the tax benefits of contributing to retirement accounts like 401(k)s and individual retirement accounts, or IRAs. These accounts are not just a safe haven for your hard-earned money, they also provide significant tax advantages that can help lower your taxable income. First, let's explore 401(k)s. This is a retirement savings plan sponsored by an employer. The beauty of a 401(k) lies in its ability to reduce your gross income. The money you contribute is pre-tax, which means it lowers the amount of income you're taxed on. For example, if you earn $75,000 a year and contribute $5,000 to your 401(k), you're only taxed on $70,000. Over the years, this can amount to substantial savings. Now, let's discuss individual retirement accounts, or IRAs. There are two types: traditional and Roth. Contributions to a traditional IRA may be tax deductible in the year they are made, which can significantly reduce your tax liability. The Roth IRA works a bit differently. While contributions to a Roth IRA are made with after-tax dollars and thus not tax deductible, the withdrawals in retirement are tax-free. This could be a great option if you expect your tax rate to be higher during retirement than your current rate. But remember, there are limits to how much you can contribute to these accounts each year. For 2023, the limit is $19,500 for 401(k)s and $6,000 for IRAs. And if you're 50 years old or older, you can make additional catch-up contributions, so why not start saving for your future today? The more you contribute to your retirement accounts, the less income you'll have to pay taxes on. Not only are you preparing for a comfortable retirement, but you're also reducing your current tax bill. It's a win-win. So, there you have it. Some little-known ways to save money on taxes. We've traversed a journey together, exploring the labyrinth of tax-saving strategies, and now it's time for a quick recap. Let's rewind to the beginning. We started off by understanding the importance of knowing your tax bracket. It's like a roadmap that guides you to your tax-saving destination. Remember, the more you earn doesn't necessarily mean the more you pay. It's all about the percentage of your income that falls into each bracket. Understanding this concept can truly make a world of difference in your tax planning. Next, we talked about the magic of tax credits. These are not just deductions from your income, they're reductions from your tax liability. It's like having a secret weapon in your arsenal. From education credits to energy credits, there's a myriad of options available that you might not even know you qualify for. Then, we ventured into the realm of deductions, those hidden gems that can significantly reduce your taxable income. We emphasized the importance of claiming all applicable deductions, whether they're standard or itemized. Remember, deductions are your friend. They can range from mortgage interest to medical expenses and even charitable donations. Our journey culminated in the importance of contributing to retirement accounts. Not only does this ensure a secure future, but it also offers immediate tax benefits. By contributing to a traditional IRA or a 401k, you can lower your taxable income today and save for tomorrow. These are the 4 pillars of our tax-saving strategy. But remember, this is just the tip of the iceberg. The world of taxes is vast and complex, and there's always more to learn. Remember, every cent saved on taxes is a cent earned, so take control of your tax planning today. After all, it's not about how much you earn, but how much you save, and these strategies are a good place to start.